Well, we are on the last day of this second quarter, and what a quarter it has been. Stock markets finishing the day with a little bit of further push, ending up at the very top of the starting line for the year here for the S&P 500. A quiet day, nevertheless. And a lot of questions swirling about what comes next as the second half of the year gets underway. We're going to look at the macro headwinds and maybe tailwinds too that are on the menu for this week. As we always do, this is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we'll do is we'll take a look, as we usually start, with how the markets performed last week. You'll notice once you look at the breakdown there, it was a pretty one-sided sort of a situation. But once we get that done here, we'll take a look at what the markets actually did and why they did it. And that's not the table we're looking for. This is the major markets as they behaved last week. And not surprisingly here, sharp decline in yields, bringing a sharp rise in stocks. And certainly the 11.3% drop in crude oil does not hurt. That's sort of the main takeaway here. Not surprisingly, of course, that decline, that massive decline in crude oil, speaking to the situation in the Middle East and how that has worked out here. Obviously, there was a very legitimate concern that there was a significant sort of geopolitical disruption in the region as the U.S. moved to involve itself directly in the conflict between Israel and Iran. But since then, we've obviously taken a step back into a more contained sort of setting. And not surprisingly, once it became clear that both Tehran and Washington were looking to walk this thing down into a less acrimonious, or at least less explosive sort of setting, that's given us a significant come down on crude as worries about supply disruption there go away. Gold comes down 2.9%. The dollar weakens. We can see it here down against both the euro and the yen. We have a decline in yields that seems to suggest that maybe the Fed is going to have to do more easing despite their protestations. We'll get on that momentarily here. But stocks ultimately find reasons to like the canceling of a broader war in the Middle East and a pullback in borrowing costs, not surprisingly. And so the S&P and the NASDAQ here on the upside with formidable gains last week, very spirited as a matter of fact. And we start this week in the same sort of tone. Shares higher, yields continuing to fall, crude oil now just idling, but gold finding a little bit of support, and the dollar kind of a hodgepodge, down mostly, but unable to make gains against the pound for what it's worth. And so it is with this backdrop that we begin this week, where despite shortened price action because of the U.S. Independence Day holiday, there is plenty of macro on the calendar and lots of reasons to be paying attention. We start in the euro area with Eurozone CPI numbers. They're expected to give us a slight wiggle higher to 2% from 1.9% in the prior month. And this perhaps is most interesting in terms of what it might mean for the ECB next year, because what it means for the ECB this year seems pretty well established. But if we look at the policy breakdown here, we can see the ECB on track to do one more rate cut this year, 27 basis points baked in here through the end of this year. But if we look at what's going on for next year, there are no more cuts on the menu. In fact, we're actually quietly inching a little bit into positive territory. And although it's only 5 basis points so far, it's not quite the rate hike scenario where it looked like maybe we were 50-50 on a rate hike back in March, when it looked like there was all this emphasis on the defense spending that the Eurozone is going to do next year to beef up NATO. We now have a little bit of a cool down here, but we're starting to see this perk up again. And indeed, looking at break-even rates in the euro area, these are German stand-in for region-wide numbers. And we can see here, although we're not where this spike occurred in March, this was all those spending plans being front and center, and things have cooled off since, we have sort of started to anchor on inflation expectations, and that's suggesting that maybe we're going to get to a place where the euro is better supported by a positive rates story. Now, what's maybe most interesting about this is we already got the German numbers earlier today. They tend to be a good precursor for region-wide CPI, and those numbers were a little bit weaker than expected. And that has certainly not prevented the euro from rallying up a storm. In today's session, the euro is up a pretty substantial 0.6%, putting it at the highest level since September 2021. So we're essentially talking about a 4-year high. So perhaps the market isn't prepared to beat down the euro just because immediate inflation is a bit on the low side. And that, interestingly, gives us some good backing. The German numbers came out with a 2% inflation rate for June versus 2.2 expected. The core coming out, or the harmonized version rather, coming out at 2 as well. So looking at the situation here relative to expectations for the overall, maybe this then comes out a little bit on the soft side, maybe steady at 1.9, maybe even a little bit softer. But the real question is, does this ultimately hold the euro back, or does it even still care? And maybe the answer is no. In any case, looking at the makeup of inflation, the most recent numbers have food near the top of the list, as well as energy. And that perhaps is one reason why the ECB is maybe not paying a terrible amount of attention to these numbers, because if in fact you started to shave off these readings, then you're left with sub-target inflation. But of course, the ECB doesn't have much agency over global food and energy. And so maybe they're content to just stay on autopilot with what they're already intending, then let next year's fiscal dynamics drive what they do next. Then, of course, the spotlight shifts back to the US and the Fed. And here, things are very interesting indeed, because, of course, we've opened up quite the disparity in the market's policy expectations and that of the Fed. Just 2 weeks ago, the Fed gave us an updated set of economic projections, the latest summary of economic projections released with the FOMC announcement. All of that followed last week by 2 long days of torturous testimony from Fed Chair Powell, first in the House of Representatives, then in the Senate. And the message in all of this communication was the Fed is in no hurry to do much of anything, because with an inflation rate at 2.4% and a jobless rate at 4.2%, there seems no hurry to try to guess what tariffs are going to do. The Fed's expectations are that tariffs historically are a good guide for tariffs now, and tariffs historically, the Fed would argue, and evidence would support them, are bad for growth and tend to lead inflation higher. And it's the leading of inflation higher that the Fed is most concerned about, having so painstakingly been fighting inflation since 2021, 2022. So what the Fed is saying here is, look, we're not going to cut because the economy isn't screaming for us to be fighting inflation or fighting to boost employment. We know that the tariffs tend to have these influences. We're going to see what happens. Because, of course, the impact of the tariffs has been muted by the White House's decision to pause them for 90 days so that we don't really have clarity. It already takes time for things to work their way into the overall economy. It's not instant by any stretch, but when you extrapolate by 90 days the actual impact of the policy, well, then you're going to have to wait longer. And the Fed would argue that they have all the time in the world based on how the economy is performing currently. The markets, on the other hand, are not clearly seeing things the same way. Whereas the Fed baked out 75 basis points between this year and the end of next, the markets are at almost 125, which means they are 50 basis points more dovish, give or take, than Fed officials. And not surprisingly, the question then becomes, well, why? Why is it that the markets think the Fed is going to be more dovish than the Fed is saying this year? 61 basis points is clearly greater than 50, which is what the Fed has, and is about 50-50 now, 11 basis points, on a third rate cut this year. For next year, the Fed is at 25 basis points and the markets are at 63, which means, again, 2 cuts are priced in and we're about 50-50 on a third. So this is not about, as some have posited, the idea that the president wants to have a new Fed chair in the second half of next year. Powell's term expires in May, so perhaps, or at least the theory would go, the president is going to nominate someone else for that role, and that someone is going to be very dovish, and they're going to be cutting rates a bunch. Well, as cute as that is, if we look at the breakdown in Fed funds futures, we can see that actually rate cuts are front-loaded to the first half of next year, at least for next year's outlook. 40 basis points up front in the first 6 months of the year, and the remainder thereafter. So the markets are seemingly saying that there's some kind of an economic necessity for easing that the Fed is not appreciating. We can see that show up in the economic data. So looking at the outlook on data surprises, we can see this index from Citigroup that measures the way that data performs relative to forecasts. It is the most downbeat for the U.S. Now, we did have this errant spike last week around a very buoyant durable goods orders number, but that, of course, on further reflection, seems to be mostly smoke and mirrors and front-running of tariffs rather than actual demand. So at this point, it's difficult to make much hay of it. In any case, though, we can see that before that aberration, there is a downward slope to global economic data performance, which obviously isn't coming from emerging markets where things are holding steady, and is instead coming from the G10. And in the G10, it isn't coming from the Eurozone where things actually look pretty well anchored. So if it's coming from the G10 and not from Europe, where is it coming from? Well, obviously, here. So we can see that the U.S. economy, at least in terms of economic data performance relative to forecasts, is now a drag on global performance as a whole. We can likewise look at the GDP Now forecasting from the Atlanta Fed, and there are a couple things that stand out here. The first one is that the range on second quarter GDP growth expectations is shockingly wide, from 0 to almost 4%. So nobody really knows where growth is going. But more importantly, if we look at the trajectory for this GDP Now forecast, we can see that since late May, the data going into the bucket has been negative. The way that this nowcast works, and there's a little explanation right here, what we have is a model that takes in incoming economic data and is sometimes updated as often as every day. So what you have here then is a sort of running tally on the tone of the data going in the model. And you can see that the tone is increasingly negative over the past month, which of course lines up with what you see right here. Then, on top of all of this, there is of course the bond market, which, not surprisingly given where Fed funds futures are, is telling you that the Fed is wrong to feel ambiguous. That the market is in fact not ambiguous at all. That there isn't a concern about inflation expectations. And that the concern really ought to be about growth. We saw this in the beginning of the year, where the implementation of tariffs left the market so worried and so thoroughly concerned about the cyclical implications once business and consumer confidence surveys began to show that the tariff rollout was impacting them in a very negative way, that inflation expectations and stocks were falling in tandem. Stocks have obviously rebounded. Here we are back to the starting line on the S&P 500, as we mentioned earlier. But inflation expectations have not. The bond market still thinks inflation expectations are going to be just about right-sized relative to where they were near the lows in April. That obviously tells you that the market envisions some kind of disinflationary weakness in the business cycle. And of course, with all of these pieces put together, the weight of economic data this week ought to be relatively significant. First up, the ISM economic surveys, the manufacturing numbers due first. They're expected to show that the sector continues to contract, as ever these are done in terms like any other diffusion index PMIs, just like the S&P global numbers, where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So the implications here are that we're going to have a further contraction in manufacturing. In fact, this would be the fourth consecutive month of contraction for the U.S. manufacturing sector, but at a slightly slower rate than in May. So up from 48.5 to 48.8. For services, the expectation is that is going to hold basically steady. 50.5 is basically neither growth nor contraction by very much. It's modestly positive, so I suppose it's a little bit growthier than the alternative. But it's basically standstill after a reading of 49.9 in the prior month, which was the first reading below that 50 mark since December of 2022. So quite sharp there. And you were at sort of nominally, episodically as a one-off below 50 in April 2024, but of course that very quickly gave way to positive readings. There was another episodic one in June at 48.8, but again, that gave way very, very quickly. So the question then becomes, was May one of these strange one-offs, or are we looking at a more structural slowing of the U.S. service sector, which is, of course, where most growth lives? Given that U.S. economic data has tended to surprise on the downside, as we've just seen, and the overall tone of the incoming numbers, the implication would be that the risk here is for a downside surprise. But even if you don't get one, the upshot here, since services is a much bigger part of the economy than manufacturing, is that when you take these together and you kind of mentally construct a composite PMI index, you figure about 2/3 services, 1/3 manufacturing is how you'd weigh these. So you'd end up with an economy basically at 50, an economy at standstill. And then, a little bit earlier than we would normally on a Thursday instead of a Friday, we get U.S. jobs data. Here the expectation is you're going to come down to 110,000 jobs created from 139 in the prior month. And the jobless rate seen ticking up to 4.3%. Again, not very high by historical standards, but certainly a move in the wrong direction. And again, the expectation is that the risk in these numbers is of a downside surprise, and that the market is already screaming at the Fed about that risk, putting the Fed off sides and suggesting that the central bank is going to have to do a lot more easing than anticipated. If, in fact, these numbers end up endorsing the market view of policy, well, then we probably start to look higher for bonds. We start to wonder what the dollar is going to do and whether it really is done falling or whether it has a further leg lower in it as you get more of this view cemented as likelier than what the Fed is saying. Might get a bounce in gold. Then, of course, we'll see if stocks can manage to sustain this disparity. Or if, in fact, this starts to look more sentiment-driven, whereas this is where we ought to be closer aligned with economic reality, and if that means that stocks now have a vulnerability and might pull back. And that is Macro Money for today. As ever, we are here Monday through Thursday, although because of the holiday, we are not going to be here on Thursday. It's a Monday through Wednesday kind of week here. And that's right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be on, as always, with Victor Jones for the Price of Truth on Tuesday this week. On with Victor again for First Call alongside Tom on Sundays. Writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.